Hey everyone. Today is Thursday, July 22nd, 2021. I'm going to be joined by the senior index analyst of the S&P Dow Jones Indices. You might, know them better by some of their indices, like the Dow Jones Industrial Average and the S&P 500. His name is Howard Silverblatt. He is very knowledgeable. He's a data geek. And what I love about him most is he's transparent, honest, and colorful. So I'll be joined by him in just a few moments. We're going to be talking about all things stocks. He stays away from the debt side, the bond side, the fixed income side, all things stocks. And by that, we can talk about historical data, which he's rich in. We can also talk about the various, sectors and industries, which ones are hot, which ones are not. Are we too frothy? Are we too exuberant? Is there financial instability? What about inflation? What about the debt ceiling? So we have a lot to talk about, and I look forward to hearing his 2 cents. I'm sure you will as well. See you in a few. All right, and I've already introduced you. I pre-recorded that before you came on. So thanks for joining me, Howard. As you know, I have great respect for, your data, your opinions, and also your candor. So let's start with our second quarter earnings season. I know it's early in the game, but how's it looking?
First, I have to start with compliance. Anything I say should not be interpreted as a buy, sell, hold recommendation. Opinions of that of my own, not S&P Global or any of its units. So now I shouldn't get sued. Okay. If we're going to do Q2 earnings, I think we have to start with Q1 because there's an enormous number of similarities between the two. Q1 earnings actually was a blowout, as we all know now, and helped support the market and reduce those high PEs a little bit. They're still high. Specifically, it came in 21% higher Q1 than it was estimated to on March 31. Okay, so it was a blowout. Whether it was lowballed to the estimates or not, the bottom line is the numbers were a lot better than we thought. There were three takeaways that we had at this case. One is the 21%, obviously that it beat. Two is that cash flow set an all-time record. Okay, came in at about $578 billion, about $95 billion ahead of the number two, which is on Q1 2019. So it wasn't just paper parts. Depreciation helped, which is a different economic item on there. And the third was the margins, which we're seeing also. The margins were 13.02% for Q1, which was an all-time record. The average is 8.6. Okay, so go to Q2 right now. We've got estimates and we have reality. Reality is this morning, including this morning's numbers, was 104 out of the S&P 500. Those numbers are going up. 85% are beating earnings and 86% are beating on sales. I should say about 29% of those numbers are financials, which have done well. So it could be a little bit low, we expect, once you start getting detail on some of the industrials and caterpillars and those in there. But the estimates are also going up. Quarter to date from 3 weeks ago, the estimates are up 5% for the ones that haven't reported yet. We get the ones that did report, and we're seeing higher numbers. So those are coming in a lot stronger. Margins are about 12.6%. Again, those will decline, especially when you get to retail. But the bottom line is margins are extremely higher than they have been traditionally. So the money coming in, companies are able to book down a lot quicker from sales to net, and consumers are spending it. We are in the surge area, whether we are starting to increase less, the margin amount is coming down, whatever we want to argue on that, the bottom line is that it is an enormous amount of high margin items, and companies have so far been able to push it through. So that's the major item on there. Next week, we have 190 companies, 42% of the index will report on market value. Everyone is going to be focused on that, regardless of what happens, especially if you're an individual analyst. You go in your company, so you get not just the results, but the guidance on there, which means you may be changing that target price because you're going to change internally and tell your people buy or sell, or dollar average in or out, whatever you're going to do. So we could see more volatility for this week from the bottom up because of 190 issues. And obviously the apples and the Microsofts are there, but in this case, 190 is going to make a lot of commotion and volatility, whether they're good, bad, or indifferent.
So if they're good, you expect that we're going to see even more surge in prices and the market should rise even more?
I think the expectation might have gotten ahead of itself, and everyone has the finger on the sell button. We saw that Monday, but the numbers need to come through good to support where we are. Then we can talk about tomorrow. The guidance will go towards the next one, and again, the recovery and the COVID numbers and the ability to spend, which hopefully pushes corporates into higher capital expenditures, will be key on the guidance.
So when you're talking about, and we need to justify where the numbers are, we're talking about price earnings ratios, right? So the recovery
Yes.
pretty much built in at this point, unless we get even higher than expected.
It is more than built in. We are discounting 2022 numbers already, where we're selling at a PE of 21 based on 2022 numbers. I mean, that's astronomical. And if I gave you the 2023 numbers, you'd beat me out. You would just hit me on mute. We are paying currently a lot on this, but Q1 showed that it may be justified. Q2 comes through that adds another level of optimism, which is already strong on the street. And we're getting a lot of buying in there. So yes, it's high. And as long as we stay on that mark, it's justified. We'll have to get used to the higher, PEs on there. And eventually the market will have to reevaluate and say, how far out do I want to go? But right now, you can't judge it on yesterday, and you can't judge it on the surge in spending that we're having today. So the numbers at 21, it's high, it's concerning, but right now we do seem to be able to somewhat justify it. You can make a good case against it, but you can make a case for it.
When you're looking at who's buying, are you able to break out and look at, retail versus institutional, et cetera?
Yes, and we break out, obviously, the difference on the money managers and institutions is whether you have pension or not. Regardless of what you want to do, each month you have to put that out. So that was we're still trying to get commentary from. Did you notice that this is a sidebar, but did you notice that the living years longevity went down this week significantly? That's going to change some annuity plans and some pension numbers, because they do a lot of actuarial work based on that. Anyway, when we do the institutions, we have seen that institutions are not as active as individuals. Market's been going up. People are getting in, and money managers who, again, are nervous. As long as people are getting in and is buying, they're going to stay there. The minute they think people are not going to be there, they're going to move out, which they should. They've got substantial money on there. So individuals are feeding it. We're seeing this in flows. And then, of course, you have the new investors, the 20-somethings, who tell me how much they won in the market today. They didn't make any money. They won, and they have an emoji to prove it. The reality is they probably didn't all win, definitely not now, as we've changed back because they bought high based on web items. But that does speak to the future investors. They are learning an important lesson. And from at least my personal viewpoint, some of the money managers that I speak to, is that better they should lose a couple of $1,000s now than turning 35, 40 and blowing their 401k. They are learning a good lesson, and there's no better lesson to be learned than if you lose a few bucks.
Robinhood calls their margin accounts gold accounts. So I was looking at the FINRA margin numbers. They're higher. They're astonishingly high right now, the amount that's being traded on margin. And I haven't seen anybody break it out by age group at this point, but they might be betting a little bit more than they have too.
I haven't seen the margins on theirs. It would be interesting to see, but margin calls are deadly. That's why I don't let the windows be open on the street anymore. Close those windows. Margin calls, you jump. But yeah, these kids at least are learning the market, and that's a good lesson to learn.
Yeah, they're very interesting. I mean, I'm all things market. My son called me up wanting to invest in GameStop, and that started the conversation, So it was after all these years.
I get calls from my children's kids who you never, I mean, you don't talk to and they call us compared to mommy and daddy who are calling and asking questions. They don't even know what some of these stocks do. Anyway,
Yeah.
but it's good experience that they'll get. May not be profitable, but it'll be good for their future.
Let's talk a little bit about politics. I heard a couple days ago that Mitch McConnell said the Republicans aren't going to raise the debt ceiling. They're going to leave it to the Democrats to do. I know the Democrats have various ways that they can do that without Republican support. But, what do you think that sends, what message that sends? I know you're not on the fixed income side. S&P already downgraded the US, so we're probably not in trouble with you guys anymore, but Fitch and Moody's.
Yeah, and the VIX did great that Monday after we downgraded it. Went all the way up. We should have sent a bottle of champagne in for that. As far as the debt goes,
downturn before the downgrade. Remember this, the money started moving out before.
Yeah, I was talking about the VIX itself, which is an S&P product. Went all the way up. I think it was 6.66 that day. It went up.
Wow.
Which is a devilish number, yes. But I think those commentaries were partially in the structure that they're doing now for the 1.9 trillion dollar plan, as well as the family one and the sidebar one, which is only supposed to be 800 billion, small number, that they may grow on. But yes, the debt, just similar to companies' debts that we're seeing increase, okay, is a major concern on the debt side and on our side. The government has printing presses. Arthur Burns is not around anymore. So they can either print money or they can increase taxes. And one way or another, consumers are going to have to foot the bill. So they need to spend the money wisely or tax wisely. And politics does not always lead to that. So as far as the debt goes, we're coming up against some bad numbers. And if interest rates ever do go up, take that number and start multiplying it times an average 4% yield. We're not going back to Jimmy Carter to say 14, but those are enormous amounts. And then take that percentage of GDP. And we do have concern. So yes, even from a corporate side, there was concern about the national debt, how it's getting paid, what it's doing to the money supply on there, because one way or another, it impacts it. And again, we have our own issue, on debt with companies, within both the S&P 500 and mid caps.
I think we should talk a little bit about that, because a lot of people look at earnings reports and they kind of neglect the debt side of it. They aren't factoring it in. I'm sure that there are certain industries where debt is a much bigger deal than others. Yes. So why don't we talk a little bit about where you're seeing concerns in the debt side?
Okay. It breaks that to two parts. Within the S&P 500, which is different than the rest, where there's more of a problem, they have higher liquidity, more access, and more resources, better cash flow in general. Not everyone obviously on there. They have been borrowing more money, okay, but they've also been replacing old money. They've done the refinancing and they've added extra money and some shares, believe it or not, even though we have buybacks and the counter is issuing, they've done. So within the S&P 500, the cash resources and the interest expense that's being paid, even if it goes up, is more than manageable. About cash holdings within the S&P first quarter was $1.8 trillion, sitting in banks and instruments, making very, very little.
Right.
Give that by comparison, the 1 year 2021 GAAP earnings estimate translates to 1.5 trillion. So they've got about 14, 15 months money sitting in the bank making nothing. That money is also about 37% of LTD, which is different than total debt, obviously. Right. But so it's more than manageable to accomplish coverage for interest expense, again, on the big caps, right, and more than enough for the normal repayment. Plus, they can get more. There's no problem issuing debt today. People would just grab it on there. Your worst scenario is they get 10 basis points higher. That said, moving farther down into mid caps and small caps, we do notice much more of a difficulty. They're not as liquid. They can't go abroad. They as much. They don't have the resources and the underwriting to get there. Their cash flow typically is not as good, especially when you get down to small caps. So we're seeing those numbers higher. And yes, in some groups, you have to have the concern about where that's going on there. You know, what are you getting that money? What's your cash flow? My cousins on the bond side talk about it all the time, and they have concern. And, you know, looking at my mid cap, you know, S&P mid cap and small cap, or you can go to, you know, the Russell small end, whichever way you want to do, they are increasing it significantly. It was understandable at the beginning of the year. I mean, last year, when you needed liquidity, you had to survive, you had to borrow. But to do it now, when numbers are coming in, it's concerning. And again, if those interest rates ever go up, these are fixed, most of them. We're not seeing that much on any kind of a variable. Even lines of credits have durations like 3 months at a time, which is a little bit different on the instruments there. But it's concerning.
Are there certain industries in the small and mids that are more heavily indebted, slower growth, more concerning?
Tech typically is not as indebted. And they typically have more cash. They also do more buybacks because they use that for salaries.
Right.
You know, obviously the ones you have to worry about are things like such as utilities. But utilities, while not being regulated as much, you still have to have some kind of a format. If I turn on the light, it goes on when I plug something in. So they do have a product that has high elasticity that may help them out.
Yeah.
Consumer groups, though, don't. You know, they borrow money to build or redo things. And so more within the consumer, not so much as the staples, but the discretionary ones that have to continuously borrow to do that. And then imports, exports, depending upon how the dollar goes, could be a problem there. So yeah, some more within the consumer groups on there. Banks, obviously, the regional ones, is some in the mid cap. The other ones are going to be more dependent on housing as compared to the big caps, the money managers, ones in New York or Chicago. So yeah, some of the bankings that have the lower side, the debt, you have to worry about their ability, especially with low interest rates, the margins, being able to borrow at A and sell at 20 basis points more. You can't make a living that way.
You know, I did notice, I read a lot of your data, and I did notice there was one information technology company that suspended their dividend. And I was like, who was that in the S&P, I think?
Actually, there were 3, I think, that did. One had a merger and one cut. You're going to give me a second as I look down, okay?
Yeah, I just wondered.
Alliance Data cut it last year. All 4 of them were last year. Alliance Data cut it by about 2/3.
Yeah.
They're still paying the same amount, but 3 of them, DXC, Maxim, and Weston, totally suspended. Xilex suspended, but that was a merger situation, different. Technology is not known to pay dividends, but they are the biggest dividend payer in the index. They account for 17% of all dividends out there.
Is that
said,
Microsoft and now
NVIDIA? Yeah, it's Microsoft, Apple. I mean, you know, they pay enormous amounts. They pay, it's definitely 17% of all dividends. But typically, a tech stock has a high beta. You do not buy it for the dividends. I mean, you're buying Apple. It's a great, because you like Apple. It is a nice plus to have that dividend in there. However, in general, technology has a high beta coefficient. They don't pay as much. They have good cash numbers. It's a different risk reward scenario. Yeah. Gone are the days of the old ADP and IBM, and that's not a knock on them, but it used to be ADP was a normal dividend stock, and it was technology and didn't have as much risk. And IBM to some degree. Well, technology has a lot more risk, and a lot of them don't pay. You know, I mean, the Apples and the Microsofts do, but you go farther down, you know, and they don't. So technology pays, but the yield is typically smaller because the prices and the PEs are higher.
I want to, and I'm thinking forward, like, when we talk about the markets being very lofty in terms of pricing, and I wanted to just kind of look back so that we could see maybe how it plays out going forward. So when we think back to March or February 19th, 2020 at the high, March 23rd being the low before, we got the infusion of capital and everybody thought that, that they should buy again. Who led that? Was that the institutional or the retail that led the markets down between February 19th and March
The
23rd?
down, mostly that was institutional. Individuals, at least up until June, then it gets a little bit cloudy depending upon the data you're using and where the money is. I'm an individual, but I control part of my 401, either directly outside my company or within my company.
Right.
But no, it was institutions. They ran for the door. Don't forget, 2019 was a good, decent year. They booked stuff and they ran out. We're seeing small parts of that in that now. Monday, 4 days ago, the market did decline, a big sell-off. I think it was 1.5. It wasn't a lot. But basically, everyone had their finger on the button, and when the COVID numbers came through and it got all the hype, there were sellers. The buyers moved out, as they should, and said, you want to go down. If I want to buy, I'll buy it at a lower number. And it was all one side selling. That said, Monday was very orderly. You didn't see stop orders. You didn't see difficulties in the actual execution. You saw one-sided trades. That happens when you have, buying and no selling, or selling and no buying.
Right.
And it was orderly. And it was not a massive 5% or even 2% decline. And Tuesday, the buyers were all gone, which speaks, sellers were all gone, which speaks to their depth that they weren't that many. And people came in. Not sure if they were bargain hunters, but they came back in. The sellers weren't there, so they overpowered it, and you made the money back on that day. In fact, we have the third day today of gains, and we are about a 0.39% away from the 40th high of this year.
Well, it's
a little less than half a point away from the high.
It's crazy. I mean, I have a friend who, he was telling me about certain hedge funds now that just do tax harvesting strategies for folks. You probably have known about this forever, but it's another way where the markets can be very volatile, but still tend towards an uptrend, because rather than selling, they're selling, Coke to buy Pepsi, right?
Right. You move it around depending upon what you're writing and not. But basically, this year, there should be a lot of gains out there, to start to go. Hopefully, you don't have the losses to counter it. But a lot of stocks have gone down. But, the breadth is very good, about 400. See today's numbers, but I think it was about 428, 429 year to date with well over half of them up 20% year to date. There are a lot of winners out there for this year. Moving down into the mid cap and small cap, you don't get the same, which speaks to the favoritism of big caps. On there, which I'm not trying to push one on the other. I'm just saying it's, institutions have to have concerns on liquidity and stuff, so they cannot always buy what they want to buy. But they do buy it, they have limitations on how much they can buy.
Let's talk a little bit about how the pandemic has changed our lives and what industries will benefit from that, which obviously we saw, the communications industry has definitely benefited from that, and technology benefited, but also the ones that not doing as well, like office buildings or, airlines.
Malls.
Huh?
Malls.
Malls, yeah.
Shopping malls, but it's a bit different in this situation than all the prior ones. Is the speed that it happened, at least in our lifetime. Like 9/11 was an event that happened immediately and changed some things, but this was an event that happened, as you said, like from the February 19th. We all knew about it, and the market was high. March 23rd. Market was down like 38%, and we didn't know what was happening. It was immediate. companies were shut down, people were shut down, cash flow was totally cut. I mean, you said hotels and airlines, they were closed. It wasn't a matter of anything. You had no cash flow. If I was a movie theater, it was shut. If I was a department store, Kohl's, you were closed. It's not that you weren't getting money in. You had to pay just to have your stores maintained. It was like negative was where you started from, sub-zero. And that hurt a lot of the industry. It helped other parts. So I went to Amazon. I went to Target because they have food. And you went to different areas that had it on there. A lot of people did not work, but a lot of people did work, okay, and still had income and did not go out that night, did not go on the trip that week. So there's all this bent up money that they're able to spend, which is an issue now, obviously, and a godsend, hopefully, for some industries. But other ones we saw the streaming numbers go totally up. I needed entertainment. You saw all these items. So the shift was so massive and quick that it needs to shake out. We are now starting to get into that shakeout period. We're in the period where we're spending all that spent up money, but will we change? Will we go back to the office? If I don't go back to the office, those nice charge card company restaurants that I go to, thank you, S&P, aren't going to survive. Without us. No one's spending $70, $80 on a steak down there. The hotels that are down there. And if you don't get the people going back, not as many meetings are needed. That might help Zoom or maybe a new company that's coming in there, but it's not going to help the travel industry, that hotel and airlines that use business travel, which is so much more expensive and so much higher of a margin on there. So how we go back and where we go back is going to be major to office space, and therefore how much real estate has on there. Staying within real estate, the malls as well. Am I going back to the mall? Was the mall all of a sudden going to change and there's going to be doctors there? There's going to be a gym. And does the mall become a mini WeWorks area? We see some of that in the Northeast where they're doing. So all this shift back, has to be determined of how much of retail. Will there still be social shopping? Where people go out, I want to go to the stores on there. I walk through Macy's a couple of blocks in here, and once in a while, and there's not that many people in there still. Yet their numbers are down, but it's still there. Somebody's buying it somewhere, and a lot of it's online. So how much we go back to actual brick and mortars, is going to make a big determination on the malls and the real estate in there. And the offices are going to have an even bigger impact because of meetings and enterprise costs on there. And of course,
when you think about it, though, I mean, when we're looking at price earnings ratios and prices, like a lot of the mall owners and the commercial real estate owners that are heavily into office buildings that are still empty, still vacant, their prices are higher now, or as high as they were pre-pandemic. Their price earnings ratios, they're lost money. They're still have, actually the commercial, the CRE looks better, I think, because even though the building is empty, there's still the leases going, although the sublease
that's an important item. The subleases. I know several brokerage houses that have closed off floors. They're not out of their lease. Okay, but they've closed them off. They can't sublease them because at least there's not a market for it. They may not even be able to legally do it. I'm not familiar with each one of their situations, but yes, what is tied in is there. But as that comes up for renewal, the question is, what do you do with that? If I have 5 floors and I only need 4 because I'm doing telecommuting on there and people are coming into that, what do I do with that extra 4? I'm not going to reduce the rent that quick if the old thing for real estate, if I reduce your rent, I'm going to have to do it to the next person. And it's a domino. So I may have to swallow it and have it empty, which means you need deep pockets, which speaks to the debt numbers and the cash flow of real estate on there. But yes, how much goes back to the office is an enormous amount, and it will shift. I mean, I don't think anyone thinks we're going to get back to where we were before. It's changed. We have changed. We all have changed. We functioned so long, so many of us, away from the office. Now we need to, to get back for certain reasons, but not all of us.
Do you want to talk a little bit about value versus growth? I mean, we certainly have seen that growth has kind of led the recovery, hasn't it? Beating value out a little bit.
Yeah. Many places are redoing their definition, the old definition for value, using book value and dividends, the Warren Buffett idea, the 10-year treasury and the plowback numbers. We really need a better definition for that. The growth that we're seeing also does appear to be shorter term investing, okay? Because it gets pulled out. You're getting a good turnover in there. Whether it is tax harvesting, I have no idea, but it's significant. So we are seeing more on growth. The belief is that eventually value has to come back for long term. Because when you're going long term, you need that risk reward scenario, and you have to put the two together.
So high value when the markets are at an all-time high, even the dogs, right?
Dogs in the Dow used to be a good one.
Yeah.
Yes, those are based on the dividends. But the growth items the growth in value, at least from the S&P ones, which is the old city ones, appear to be more shorter term investing on there as compared to longer term. Longer term doesn't get the turnaround, obviously. It doesn't get this is in this week and out that week. So we're going to have to wait a little longer. But the short term is that, yes, exactly as you said, one has been going up, the other one has been going down. Like being in the old small caps when they were declining there. If you liked it at this level, you're going to love it here. But we do need some better work on the growth of value to better define them, especially if this market stays shorter term. Which most people don't think it will be, but you can't tell. So if the investing stays short term, we need better measures of investment for those. If it goes back to long term, we still need definitely better on value.
Yeah. I'm thinking also, I was reading the financial stability report and they were talking about elevated appetite for risk and how if that shifts for some reason, that, there's several asset classes probably at the top of the list would be both real estate and stocks that could have very swift volatile downtrends. But when you look at a 7% GDP year, which we haven't seen in, I don't know, I can't remember the last time, it doesn't seem like that there's going to be any stimulus to take the appetite for risk off. Do you have any comments on this?
I don't do a GDP number itself, but I do a lot of numbers, and the 7% does work very well into there, especially fourth quarter, which is expected to be so much better. We're coming off some bad numbers. At least on the street, it's the FT. And I don't mean the Financial Times, the Fed and Treasury. If you don't fight the Fed, don't fight the Fed and the Treasury, and they're both stimulus. Okay, and those are all adding on to it. I think the risk is there. I think I see it in all the reports I get, all the money manager ones that come in, and the outside ones, because I get a lot that, they do pass through, thankfully. And they all have risk, but I don't see their investments following through on those ratios. I mean, Sharp is not in as much as it used to be, the old risk reward scenario on there, but it's still definitely there. But again, as long as you have stimulus on there, you don't have to worry about it as much coming in. The question is, how quickly do you react when you think the stimulus is not going to be there? Forget when it's not there. By then, it's after the fact. Monday, you thought COVID was going to get interfere, and you saw the sellers come in and the buyers leave. And we've seen that several times over the last several months. Okay, we haven't seen a real downturn. So risk, I believe, is a major item here, and is significant. And I'm not talking about the portfolios within necessarily money managers, talking individuals going in there. I don't think they realize the risks on everything. I mean, this market is almost double from that March 23rd drop point on there. There's a lot of money built up. That means somebody got in at the top and the bottom. The market could do the bear and drop 20 points. And we're still in decent shape. The PEs, I'd still be saying, is higher. Instead of being 21, I have a 2022 PE of 18 and a half. I don't know how many people want to defend that. So yes, I think risk is a major item. I don't think it's appreciated as much
I think
And it's,
it's in the younger retail market as well, right? Like you're saying,
oh,
so
no
media
risk there.
oriented that they don't realize emotions are actually not a good strategy for investing.
Right. Yeah, again, going back to some of those 20 somethings, you know, when I talked to the few of them, you know, that literally called my kids, you know, who used to know me, you know, but I wanted to double. That's not a way to do it. Or I want the currency to hit so much. I said, take your money. If you think it's going up tomorrow, stay in it. If you think it's going down, you get out. To say I doubled it for boasting, you know, that's only boasting. You need to do cash flow
I want
on
to
there. But
ask you because you said you've seen some sort of cool emoji when they won. Do they
yes,
use
when
that the
yes,
double emoji when they lose, or do they just?
they don't talk to me about that as much or each other. My daughter did have a nice gain, and it turned into a loss, and she cleaned some of the stuff up, but some of the stocks she wasn't even sure what they were doing, but they were pushed, and she was up nicely on a percentage basis. You know, not a big portfolio, but they're learning on there. But yes, they won that day as compared to, you know, I went to Vegas and I won at the table, but I lost at what?
Yeah, and you always only hear the with the one time they won rather than the 50 times that they didn't, or even the next
But
day.
that's feed into each other. You know, again, these are tomorrow's trades. And think back to the first trades we made. You know, it's a lot different when your own money is on there, or when you have to report quarterly to your holders. You know, where do you stand on this?
Yeah.
You know, so it's a good education. Difficult, but it's good.
Well, and you're right. It's also good that they're playing. Like I think that parents should just be aware of that. It's a lot more fun for them to play with a small amount of money that they can learn on, and getting money in the game allows you to actually learn. Right? When you're just doing fictitious portfolios, you don't have the
You don't feel it.
yeah, you don't
Yeah,
feel it.
yes, but you don't feel that loss as much.
Or
You
the
know,
gain. I mean, the exuberance
it's the loss.
is a
Yeah,
drug too.
yeah, both. But the loss means that, guess what? I can't go out tonight with my friends. So I can't go on that vacation. I've got to cut down. It's not the, you know, the controlled item. I'm putting so much in there, and if I lose it, I lose it. I'm staying the same.
Yeah.
You know, so I think a loss is, I believe a loss is good for a kid. You know, or learn it.
The Dalai Lama.
I learned it that way.
Yeah. The Dalai Lama always says the enemy is a great teacher.
Yes.
Losses
Teaches you the lessons. You always learn this.
Okay, so thoughts on multi-generational homes. You know, the median home price just hit another record.
V63.3, I think. Yeah.
Yeah.
Yeah. Well, the housing, at least outside, appears to be we have two moving components right now. One is the supply situation.
Yeah.
Similar to what we had in oil about a year and a half ago. The supply in this situation is not there. People aren't moving as much, so you have fewer houses for sale. People who want to move have increased because they're moving from Midtown. I'm going out to the burbs. I don't have to be in the city all the time. I'm going in twice a week instead of 5 times a week if I'm going in. So we get that change coming in there. And that pushes prices up on there. We've seen supply side get a little bit better, but still very poor by any measures. And you can use the FH or you can use the S&P or the associations, which came out today with the 363 average, average price. They all basically showing it's getting a little bit better, but nowhere near until you get more supplies in there. The demand is expected to slightly tick down on a family basis because the summer is the big time. People very often move up and move to the burbs based on their kids when school season starts. So summer is big. And if you want to be in that house for summer, September, that house better be on the market. You better be in motion and buying it at this point. So that should drop off. But the expectations currently are still that demand of the shift, moving from the high rent areas to the lower rent, as well as the high tax states to the lower tax states. I mean, you don't even want to talk about, California and Texas, situation as compared to New York and Florida, but the corporate one on there, the battles that are going down there. So we are seeing this shift, and it's going to create a difficulty for the first generation house buyer, because they're the ones who are not going to be able to get the money as quick. We saw that, if you remember the Roth that was started by Senator Roth, part of the logic there was that the people coming out of school were not able to buy houses because they had student debt. Otherwise, they didn't have enough money to get that intro house. And if you don't have the intro house, that person selling it doesn't get enough money to get the next level. It's a pyramid, but it's a part of the cycle, all going out. And the concern now is that if you start that up again, how do you alleviate it on there? How do you, give them enough money? I mean, to bring back the idea of, 3% down didn't work out well the first time. You need to be able to support the house. So yes, younger people appear that they're going to have a difficulty financing that house. It's not a matter of, do I get a 3-bedroom or a 4-bedroom? They want to get that starter house, and which could be a fixer-upper. And so that's going to be a big difficulty on there, similar to the way we had it previously. But again, short term, we have to see where the numbers go. But when interest rates go up, that mortgage cost is going to go. And lumber, even though it's come down, it's still a big cost. If new houses cost more, the secondaries cost more, the resales cost more.
Do you think there's more shadow inventory than people are aware of with the people that haven't paid rent or haven't paid their mortgage, or maybe out of their skis, their mortgage is underwater? I mean, it's less on that, but it's still over 2 million underwater mortgages, believe it or not, even at today's prices. And 5 million people weren't able to pay mortgages or rent. I know we've had a lot of money coming in that was supposed to end, and then it came back. So when are we going to stop paying people not to pay rent and not to pay their mortgage?
Pretty soon now, because some subsidies and freezings are going to expire, and we'll see how much of that is true or not. I've attempted to get some of those numbers. I get the gross numbers, but I don't have detailed numbers. Luckily, that's not a major item that I have to do, because otherwise I'm sure somebody would know, but I don't. On the rent numbers, there's got to be some kind of a group that's just saying, I don't have to pay, but there's going to be people who do not. Remember, the people that were unemployed, even though we had an uptick, for example, today in that, on the report today that was put out by Labor, to get the upswing in claims to 419, last year at this time it was 32 million people were collecting money. A lot of people still are not in good shape. They did not do well during COVID. Income may have been lower. They may have lost their jobs. And they truly need the money, and that's the difficulty. Who needs it and who doesn't? Throwing money just at it usually doesn't solve a problem, but figuring out who does and who doesn't. We are a country of rules and regulations, but we want to be a humane one. And if you need the money, you should, some help, you should get it. But everything is lumped together. So I do not know how many are in there. I expect it's a nice percentage of there. The mortgages under there, we'll get a better idea, obviously, by September and October on there. But I would suspect if it's a significant amount and it impacts the financial houses and the bonds underneath and the agencies, whether you believe in them or not anymore, Congress will move in. Because that's grassroots. They will move in to do something the way they have previously. But I do not have a decent handle on that. People you can reach out to, but it's not me.
If you were looking at the REITs sector, would there be certain REITs specifically that you might be more interested in and certain ones be avoiding?
I obviously would break them down by the office holders, by the city ones, by the malls, okay, as well as the debt numbers to see what their collateral is and their leasing guidance. So I definitely would go into there, and I would go into some of the regional ones, depending upon what they are, where people are migrating to areas. I touched on the tax situation, but in parts of Florida, people are moving in. Corporations are moving into Texas even more. I mean, it's a huge state, but if you've got significant holdings on there, you need to weigh that against, I have a holding also in San Francisco, where it might be going down because they're moving from there. So yeah, you really need your work on there, but I would definitely break it down to the demographics of it. Buy their holdings. You're never going to get their occupancy rate and the average life of tenant, the way you do in pensions, but you can get an idea of where they're more susceptible to, and then on a demographics basis, say, this area, I want to be more in. I want to be in where people are coming to, and there's going to be a higher demand. Even if it doesn't meet expectations, better than people leaving, I'm going to have to repurpose or sell my properties.
Because I think a lot of these, even the ones that I would consider more vulnerable, like say office buildings in New York and San Francisco, malls, they are still paying high dividends. And I think a lot of people are just not aware of the risk that they're getting. They're so excited about the dividends, and they're not even thinking, I don't go to the mall anymore, or nobody's at the office.
A lot of those dividends are because they use, as compared to earnings, obviously they use forward funds. And the tax code says that you have to pay out 85% of that. Otherwise you get taxed on. So they don't get taxed if they pay out 85%. So what comes in goes out. And what's coming in is a lot of those leases, which may not be renewed again. So you're getting current money. But my question is, what am I going to get in 2 years? How much are they going to have on there? They're paying out 85% of what my numbers now is different than 85% later on there. So again, it's a lot of pass-through based on the funds numbers that real estate companies make, which is partially because of tax code. But again, you're getting the income. Not everywhere, but you are still getting significant income. Big companies that are continuing to go on, even if they are not prospering as much, typically are not defaulting. They're not going through that unless they have to. Smaller ones, yes. Small ones, you see a lot more. Again, the 500 as compared to the mid cap, small cap. Forget about micro is a totally different story. I don't think I remembered. Maybe back in the 70s, I started S&P in 77, but not since the 70s, early 80s. Such a differential in the characteristics of big caps, mid caps, small caps. We didn't even have a small cap and mid cap back then, but those and the micro size, what big companies are able to do as compared to the much smaller one. I have to think about it. It might be a topic for another discussion, but since the 80s, I don't remember anything really this glaring when we talk about characteristics.
Interesting. Well, I thank you for your time. Do you have any last words of wisdom for, I think we tend to get more retail investors. So any last words of wisdom for retail investors?
Know your risk and pass it on. Know exactly what the potentials are there. Do not be greedy. The old Wall Street saying, bulls make money, bears make money, pigs get slaughtered. I'm not looking to be a bear and push things, but dollar averaging in and out, you have to know your own tolerance. If the money that you've made, you sign. If you can't, then you need to take it off the table. Yes, you won't make more, but the bottom line is you shouldn't be investing in something if you can't afford to lose, regardless of what you believe to be true. The market still has volatility.
And the markets, I'm old enough now to have seen a few turns, but it seems to me like the recessions in the 21st century are very different than the downturns in the before people could sell with a button.
Right. Definitely the market, the transaction is different. When I came to S&P, it took me over a week to open up an account. I literally needed my passport. I can open an account now and use every penny in 5 minutes. It's a lot easier. The kids invest in different ways. Remember, you used to have to buy a lot, 100 shares. Now I could buy $5 of a stock.
Yeah.
Different types of investing. You're not worried that the stock is a $200 stock. Microsoft, $85 stock. They didn't talk about the earnings. It's who's going to buy something that expensive. Not a concern anymore.
Very interesting. Interesting times. Well, thank you again. I hope you have a delightful dinner, and I'll see you in hopefully soon, not next year.
At some point, be safe.
All right, gang. And I'm going to show you where you'll be able to see, you can watch this back, you can share it with friends. I'm going to share the screen. So what you need to do is simply go to youtube.com/Natalie Pace. So if you go to nataliepace.com, you can probably find the YouTube channel there by clicking on that picture there. But you can also just open up a window and go to youtube.com. Hold on, I'll show you on mine, /Natalie Pace, and it will start playing automatically if you do it in the next 24, 48 hours. If not, if you're looking for it in the next week, then click on videos. And then as you can see there, you can probably even find last year's video with Howard. So thank you again for joining us. And I really appreciate your wisdom and your candor and your transparency.
Take care.